Welcome, subscribers, to the Saturday Summary for August 9th of 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Illy of Brokers Alliance, here for the biz. Well, the first full week of August saw the broad indexes post gains after a tumultuous week. As with last week, the major action was on Friday, with the S&P 500, the Dow, and the Russell 2000 index gaining over 1% on Friday, and the NASDAQ not far behind. Now, the Friday rally brought the markets out of what was initially looking like a repeat of last week's losses. To end the week with the S&P and the Dow up about 1/3%, the NASDAQ up 0.43%, and the Russell 2000 index rallying to close the week with a gain of almost 1.5%. Now, despite this, the Russell and the Dow remain underwater year to date. Now, as we see at the chart here, summer has been basically sideways action in the broad markets. Now, Friday's market action was a good example of the speed at which markets react in this era of high-speed computer trading. We see this in this chart to the right here, showing the movement of the S&P 500, the Dow Jones, and the NASDAQ indices on Friday night. Now, note that at about 10:15 Eastern Time, all three indices are moving lower for the day. At approximately 10:30, the initial second quarter U.S. GDP revisions released by Goldman Sachs, Barclays, and JP Morgan, all revising second quarter GDP downward. Now, note that this nearly vertical rise in the indices over the next few minutes. Now, similarly, at about 1:15 p.m., two Twitter messages were released indicating that Russia wanted to mediate the conflict in the Ukraine. Again, we see a nearly vertical rise in the indices over the next few minutes. Now, this actually illustrates two things about the state of the markets at this late stage of the bull. First, how quickly the trading computers react, and bear in mind they will react just as quickly in the opposite direction when the time comes. And secondly, the sort of split personalities of these markets. Bad economic news, represented by the downward revision of second quarter GDP estimate, caused the trading computers to buy, exhibiting the now commonplace bad news for Main Street is good news for Wall Street behavior. Potentially good news in the form of the supposed de-escalation of the Ukraine crisis also caused the trading computers to buy. The lesson? In this Fed-supported market, nothing really matters much at all. Not company fundamentals, not geopolitical risk, not economic conditions. This seems to be purely short-term technical trading to sort of eke out the last gains before the bubble pops. Now, let's hope it does not pop, but instead deflates slowly. It'd be much better for this bull to die with a whimper than with a bang. Remember, a crash helps no one. Now, July saw money leaving the S&P 500 exchange trading funds in the largest volume since mid-2008. Now, this chart shows the outflow from the SPDR S&P 500 ETF, which is considered a proxy for the S&P 500 index. Now, the red activity at the bottom of the chart shows the in and outflows. As is clear by the dotted line at the bottom, the outflow level in July was second only to mid-2008. Now, I would say this is an indicator of nervousness and perhaps the start of a flight to safety. Now, poor suitability and poor product knowledge criminalized. Hey, it was great news this week to hear that a former agent who sold annuities several years ago in California was released from jail and had all the charges of theft, burglary, and embezzlement dropped. Now, this was the second instance of overzealous prosecutors in California trying to criminalize agents who sold poorly designed annuities. Now, in both cases, the prosecutions were related to the sale of the exact same annuity product, and fortunately, in both cases, the charges were ultimately dropped, but not before devastating the lives of the agents. Both situations should remind all producers of the importance of suitability and knowing the details of how any financial product will work both pro and con for your client. Now, at Brokers Alliance, our producer clients receive support that ensures you fully understand the product and helps you select the best product for your client's needs. Now, clearly, in both these California cases, I can only assume the agents were unknowledgeable. Given the specifications of the product in question, which has mercifully been pulled from the market, and the client situations. Now, in the most recent case, the producer admitted in various interviews that he really didn't understand how the product worked. Now, while that is, of course, the ultimate responsibility of the producer, good marketing support could have prevented the problem in the first place. Aaron or Rich would never have let that happen. Now, overall, what this reminds all of us about is the importance of proper positioning of annuities to the client need. Brokers Alliance IFL Lifetime Income with Guaranteed Annuities programs does exactly that. Our unique and highly detailed retirement income forecast process identifies the year-by-year income gaps during retirement, providing both the client and the insurance professional with a solid mathematical basis upon which to base annuity premium and guaranteed lifetime income. Call us at Brokers Alliance to learn more about that. Finally, our quote of the week is from David Stockman, of course, the former head of the Office of Management and Budget under President Reagan, who wrote, "Stated differently, the Fed's explicit campaign to force grandpa out of CDs and into corporate bond funds has caused a vast mispricing of liquidity." As always, Mr. Stockman, well put. Anyway, that's your Saturday summary for August 9th of 2014. Hope you have a great weekend. We really look forward to seeing you next Saturday.